The other big story of the week came from a few words from the boss of BHP Billiton's iron ore division, Ian Ashby, to a mining conference in Perth. Now, the speech had a fair bit about infrastructure, but also some comments about demand for iron ore. Here's a part of the speech.
We forecast that world iron ore consumption will continue to see strong growth of around 3.5% per year until 2020. Over the same period, we expect the demand for seaborne iron ore to increase by 4.4% per year. Looking beyond 2025, Chinese demand is expected to soften markedly as a consequence of steel industry intensity per capita reaching its expected peak in the latter half of the next decade.
So that statement wasn't terribly bearish, but he did use the word flattening demand afterwards, apparently, when he was talking to reporters. And then we've got a graph here which shows that actually the flattening thing is actually true. We're seeing the decline in growth of iron ore imports into China from 40% down to 5%, but it is still growing.
Well, that's the thing, it's still growing, and people forget the enormous profit margins in iron ore. I mean, BHP and Rio and probably Fortescue dig it up allegedly for $40 a tonne and sell it for 120 to 150. Even if you lop 20, 30 bucks off that price, it's a profit margin that would be absolutely fantastic in just about any other industry.
I mean, the context of that statement was, you know, in the middle of this period where we're worried about growth in China, obviously, and also there's a lot of investor concern about the huge amount of capex that BHP's lined itself up for, which, you know, doesn't have payback for many, many years. So I think that, you know, that's why you saw that quite severe reaction, which probably was a little bit overdone.
I guess it gets back to what Ed was saying too before. Everyone's very skittish at the moment, so any hint of a problem, and they just head for the exits straight away.
Well, I think that's the thing. That chart, the share prices of BHP and the iron ore price. The question is, do those prices imply sort of 15 to 20% growth for the next 4 or 5 years? In which case, 5% is disappointing to those, you know, to the marginal investor.
Well, that's the thing. The immediate impact of Ian Ashby's flattening demand phrase was BHP share price, and the Aussie dollar did a neat impersonation of a couple of synchronised divers. Now here's Bell Potter's take on it, with apologies to MasterCard. Invitation to give a keynote address at an iron ore conference. Cab fare to the iron ore conference. Market capitalisation lost in your own stock after you speak. Priceless. It was amazing, actually. The way that they just went after it, and the Australian dollar went from mid 105s to mid 103s in like a few hours.
The weird thing about the share prices of BHP and Rio, and this is what I find strange about the market reaction, it's not like those companies are priced for perfection. I mean, they're on a high single-digit multiple, you know, unlike some other businesses. I'm surprised that the market really took the stick to, especially the BHP share price, as much as it did. I think it's overly focused on iron ore.
Well, I think hedge funds are using BHP and Rio in particular to trade. You know, and they're just moving. No one's taking a view about the long term on either company, or at least the marginal price setters in BHP are not. The marginal price setters are just trading in and out during the day, aren't they?
And that's right, and you're seeing the same thing with the $8. I mean, it's having gross movements. Right now, it's 104 cents. Just days ago, it was 107, 108. You know, that shows some very skittish FX traders as well.